Hi there, business owner. Do you want a better understanding of business finance, what your numbers actually mean, and stories of the highs and lows of business, where I'll be sharing my tips and tricks every week? Then you're in the right place. Welcome to the 3Bs podcast with Stephanie. Hello, welcome back to another week of the 3Bs podcast with Stephanie. I hope you're well and I hope you've had a fantastic week. This week we're going to be covering 5 reasons to submit your tax return early. This won't be quite as filled with rates and figures as last week. This is much more of a conversational episode, and I just wanted to talk more about self-assessment tax returns, what they are, and 5 reasons why it's really worth getting them in early. So let's just get straight into it. Self-assessment is a system that the HM Revenue and Customs, or HMRC, use to collect income tax. Now, throughout this episode, I'm going to call it self-assessment or tax return. This is the same thing. It's just that people who are self-employed usually submit a tax return. There is many other reasons why people will submit a tax return, but self-employed people is the most common group of people who are asked to submit a self-assessment, and that is because if you are employed and receive a wage slip or a salary, have pensions and savings, tax is usually deducted from them automatically, which usually means that a tax return does not need to be submitted. Now, as per episode 1, the tax year runs from the 6th of April to the 5th of April each year. So if any of the following things I'm about to say apply to you within that tax year, that is when you must submit a tax return. It could be if you were self-employed as a sole trader and earned more than £1,000. And that is your £1,000 sale. So that's not profit. That is literally just £1,000 sale before any expenses are deducted. If you were a partner in a business partnership, or you earned £100,000 or more, you will be asked, or you must send a tax return in by the deadline. You may also need to submit a tax return if you have any untaxed income. So if you rent out a property, have a buy-to-let, you receive tips or commissions that are not already taxed. You have income from savings, investments and dividends. Dividends are if you are a director of a limited company, you can receive dividends from that company, which are not taxed at source, and not taxed by the company, so you need to submit a tax return to declare them and pay any taxes due. And also during COVID-19, if you received any grants or support payments, you would also need to submit a tax return for that. Now, there's also reasons you may want to send in a tax return, but you don't need to, and that is to prove you're self-employed if you want to claim the tax-free childcare or maternity allowance, for example, or if there's some income tax reliefs that you want to claim that you're not already doing so, then you may want to send in a tax return or a self-assessment. The other thing to mention is if you get a child benefit and you or your partner earn over £50,000, you may need to send in a tax return and pay the high income child benefit charge. So if you earned £49,999 and your partner earned £49,999 in that tax year between the 6th and the 5th of April, then you will not need to submit a tax return or pay the high income child benefit charge. If you earned over £50,000 and your partner earned £0, you may still also need to send the return and pay the high income child benefit charge. Now, if you do need to submit a self-assessment tax return, for example, for the 6th of April 2022 to the 5th of April 2023, which is the last tax year we completed, then that needs to be submitted online by the 31st of January 2024. And that also includes any liabilities that need to be paid and must be received by the HMRC by the 31st of January 2024. If you submit a paper return, then you need to do that and the HMRC need to receive it by midnight on the 31st of October 2023. And if you have not yet registered for the period 6th of April 2022 to the 5th of April 2023, and you need to register for self-assessment, if you're self-employed, sole trader, or want to register a partner or partnership for taxes, then that must be done by the 5th of October 2023. Now, if you miss the deadline for filing your tax return or paying your tax return, there is 2 different penalties that you may receive. If your tax return is submitted late, so if the HMRC receive it after midnight on the 31st of January, then you will receive a £100 penalty, a £100 fine straight away. Now, the second type of penalty you'll receive is the payment penalty. So you could submit your tax return on time but pay it late, in which case the £100 late filing penalty would not be applied to your account, but you would receive a penalty for paying your bill late, which varies and can be calculated on the gov.uk website. If you know it's going to be late, you can sort of use the calculator to estimate what the fines and penalties you will receive are. So, for example, if you submitted on time and you knew you wasn't going to make a payment until the 28th of February, and your tax bill was £1,000, you would get interest for added to your bill of £4.52, and you wouldn't receive a penalty for paying your bill late on top of that interest. So the total you would owe would be £1,004. Because they tend to round it down to the nearest pound, which is always something worth noting when you're using these calculators on the gov.uk website. But now let's get on to the 5 reasons why I feel you should submit your tax return early each year. So these are in no particular order, so no one is more important than the others, but number 1 is to get your refund quicker. If you're due a tax return, the sooner you submit your tax return, the quicker you will receive the refund. Now, this is very common in CIS, construction industry scheme subcontractors who want their self-assessment done the moment the tax year is ended, because with the CIS scheme, 20% of their income is stopped at source and given to the HMRC. So in effect, the HMRC are holding some of the money that belongs to the subcontractor or subby. So they are the first group of people who usually want their self-assessment tax returns submitted and completed as soon as possible, so they can receive any tax refund due, and obviously they want their money in their bank sooner than anyone else. Number 2 on the 5 reasons why you should submit your tax return early is to get it out of the way before Christmas. Why head into the festive season with your tax return playing on your mind, worrying about your tax bill, knowing it needs to be done in January? For accountants, January is one of the busiest months that we have, so it's a really good idea to get it finalised before the Christmas break. Your accountant is going to be less stressed, definitely, and you can go into the festive season knowing it's all done, it's all taken care of, and enjoy it. Like, our jobs as bookkeepers and accountants is to help business owners sleep better at night. We don't want you to be fearful of a tax bill. We don't want you to be fearful knowing it's tax season. We don't want to come to work in January dreading it. I mean, I, for one, absolutely love my job. I bounce out of bed at 5 a.m. or 5:30 on a Monday morning, and I cannot wait to come to work. I really, truly love my job, and I know I'm one of the lucky ones. And in January, it can sometimes lose its shine because of the stressful, all the clients that come out of the woodwork. So yeah, get it out of the way before Christmas. Enjoy your Christmas. Let us bookkeepers and accountants enjoy our Christmas too. We all deserve a break every once in a while. So yes, I recommend submitting your tax return before Christmas, well before Christmas. And then we move on to number 3, and that is that your tax codes can be updated. So this is slightly different in that the deadline for this is the 30th of December rather than the 31st of January. But if you owe less than £3,000 in tax once your self-assessment has been done and your tax liabilities have been calculated, and you are employed, so you receive a salary on a pay slip. So this is often where an employee is employed and has a job on the side, or maybe a buy-to-let property, and the tax that they owe when you combine them together is less than £3,000, and we submit it before the 30th of December. You can ask to have your tax code adjusted and the tax collected from your PAYE salary in 12 equal instalments in the following 12 months, rather than having to pay all the tax due in one lump sum by the 31st of January. Again, it's a good idea to get it in earlier so that especially if you haven't budgeted for any tax, that you can get it put into your PAYE salary over 12 equal instalments. I think that's so much easier to manage for most of my clients who have more than one job, or even more than one business. If they have a payroll in one of their businesses, it's a much easier way to do it. Number 4 is that you would save accountancy fees. Most accountants charge a premium for their services if you leave it to the last minute. So, for example, in my practice, ABCS UK, if a client comes to me after the 31st of October and instructs us to do their self-assessment, there is a premium added to their fee because we have to get in more staff or work more hours to fit that, because we don't want you to have a late filing penalty and you don't want to have a late filing penalty. So the sooner in the tax year that you instruct your accountant, the better. And last, but by no means least, number 5 in my 5 reasons to submit your tax return early is you have more time to budget for tax payments. If you're not going to put it through your tax code, if you don't have a PAYE salary or you owe more than £3,000 in tax, then the earlier you finalise and submit your tax return, the longer you have to budget for those payments. Now, again, I'm going to bang on about this, but if you have a bookkeeper or an accountant, they should be keeping you up to date. I mean, I do it quarterly as a minimum for my clients, so that you have an idea of where the tax is, which means that it's not a surprise. But if you do have a once a year self-assessment only service, then at least the earlier you get it in, then the longer you have, you can budget. So although the deadline to submit is the 31st of January, and that's when any tax payments is due, the HMRC need to have received that money by the 31st of January. And depending on how you're going to pay, there's various days that the payment needs to clear before the HMRC receives it. Now, if you do it through online banking as a faster payment or a CHAPS payment, then it's usually the same or next day. If the 31st of January is a Saturday or a Sunday, a non-working day, then it's going to need to have hit their account by the 29th of January, for example. So that needs to be, you need to be mindful of that when you are working out when to pay your tax liabilities. If you're going to use a cheque through the post or pay by backs, then it's usually 3 working days to clear. And if you want to pay by direct debit and you've not set one up with the HMRC before, it's 5 working days. So if you take that into consideration with a weekend 31st of January, for example, you need to be making that payment at least a week before to ensure it reaches the HMRC on time, so that you don't receive a late filing penalty or any interest. And this is kind of a 5B. This is all part of the same with the having more time to budget for any tax payments due, is that the longer you have to pay the tax owed, the longer you have to budget and you know what the tax liability is going to be, it allows you to fully focus on the current tax year and give you an idea of what to also start saving in the current tax year, so that you've already got the tax saved when it gets to the end of the next financial year. And I couldn't finish this episode without a top tip of the week. And this week I've got 2 to keep in mind when submitting your self-assessment tax return, because they both interlink and I couldn't choose just one. So my first top tip of the week is to double check your personal information. You can go into your government gateway if you're submitting it yourself, or check with your bookkeeper and accountant if they are doing it for you, that your name, address, national insurance number and other details are correct, to avoid any processing delays or errors, because the HMRC take a long time to fix anything that is incorrect. And secondly, to keep a copy of your tax return. Retain a copy of your tax return for your record, along with any supporting documentation, because if you used to submit it yourself and you instruct a bookkeeper or accountant, or you change bookkeeper or accountants, it's really helpful when calculating your tax liability and submitting future years. And that brings us to the end of another week of the 3Bs podcast with Stephanie. Thank you so much for listening. I'd really appreciate it if you could like, subscribe, rate and review this podcast wherever you are listening to it, so that I can reach more business owners and help them build better businesses. See you next week for the next episode.